In my opinion, it's a transformational company. In other words, we view it as sometimes these companies have hype and there's no meat on the bone. Here, we view it as really a three-head monster in terms of ride sharing, eats, and freight. We believe a valuation of $100 billion plus is warranted on the sum of the parts. That's how we value an Uber versus a Lyft, which we view as more a one-trick pony. So in our opinion, Uber is the real deal in terms of the distribution platform and where ultimately they commoditize.
At what price?
So $65 is our price target.
Right, and that gets you a $100 billion valuation?
Yeah, about 109.
Okay.
And that's really on the sum of the parts.
So, but just so we're clear, if the price actually goes higher, you are therefore bullish, or you think it's overvalued?
Oh, no, I mean, we continue to think this is a name that's going to continue to re-rate as they execute. So I think this is just the start in terms of from where I think this thing could trade.
What I'm asking is if on day 1 or day 3 or day 5...
your price target's hit.
Your price target is hit, you say you're going to go re-rate it and raise the price, or you say to yourself, okay, my sum of the parts analysis is what it is, and therefore... It would be overpriced. We can talk about what happens if the stock goes below that.
Sure.
That's a different
story.
It's
a good point, and we view it from the sum of the parts. I think it starts as 65.1. There's flexibility. This could go higher. We've kind of viewed it as 65 as sort of a base case. On a bull case, you can get to 75.80 in terms of where this thing could trade. And ultimately, look, even though it's a supply-demand in terms of where investors are willing to pay, the value is fundamentally on the distribution platform. Right. And that's what I think separates an Uber versus
We're going to break that down in just a minute, but tell us your view of this.
Sure. So look, clearly a revolutionary company. They've revolutionized mobility. They're disrupting food delivery and trying to disrupt freight.
When you start like that, there's a comma and a but.
Well, for us, it has to really do with sort of the near-term trends in the business. Mm-hmm. Long-term, we think there is a very decent chance, a decent shot that these guys can achieve kind of a premium margin in the category. Mm-hmm. That's something that we tend to see with category-leading companies in terms of, they have category-leading market share in virtually every major region that they operate in. Eventually, we think that gives them sort of premium margin. But in the near term, revenue growth is slowing quite slowly. Gross billings has been a bit more resilient, but they're having to bring their take rate down. They're fighting a lot of battles on a lot of fronts. And the margins are deteriorating in the core platform. So last year, they were able to point to this nice positive 9%, what they call core platform contribution margin, which is basically like adjusted EBITDA, but excluding autonomous and all that stuff. But it's been sliding steadily over the last few quarters.
For those listening to us on radio, since I'm not sure they saw the screen, you're initiating at what price?
We've got a $53 target. Yep, neutral rating.
Neutral rating.
Yep.
And you look at his price and you say it just doesn't make sense to you because?
Well, for us, we're not arguing that Uber doesn't deserve a premium multiple, say, to a company versus, say, a company like Lyft. And in fact, our target multiple that's implied in our price target does give it a premium.
A multiple on what?
Well, revenue. That's really the only positive number that we've got to go on here.
Premium multiple. Neither company makes money and may never, and you're like assigning multiples. That's part of the problem, isn't it? You're doing revenue.
Yeah, enterprise value to sales. Yep.
All right.
And to my point, I think in Uber, you have to look at some of the parts because
let's do the sum of the parts piece of it, because that's how you get to your price.
So in the ride-sharing piece is worth about $75 billion.
$75 billion.
When you look at the Uber Eats, that's worth about.
Tell me how do you get to $75 billion?
So ride sharing, in terms of from what you're willing to pay on where we think revenue as well as the monetization of the platform. So from an EV.
And are you a believer that it is profitable, and how long from now?
We believe we believe ultimately 5 years is where I think you can start to get to profitability. But very similar to how we viewed Amazon. If I go back a decade ago, it's a forestry tree.
Explain to me though the math of how you get to profitability on the Uber business.
Yeah,
on the straight driving service.
Straight driving, profitability is going to be an Everest-like uphill battle. Where the profitability ultimately comes is it's going to be eats, freight, and some of the other areas.
Okay.
Where
but if you're effectively saying that the driver business, which you just said is worth $75 billion, is actually going to be very hard to ever be profitable, how's that piece of it worth the most?
Well, I think the ride-sharing business will start to be profitable if you look at the next 5 to 7 years in the near term right now for them. as Tom knows, it's about investing in drivers. It's about take rates being stable and almost pressure.
Isn't investing in drivers sort of a misnomer, because you are basically giving discounts to these drivers, but you're not investing them because they also drive for Lyft. So there's no investment where there's a return on that investment necessarily, except that they're going to take that one next ride. They're not with you necessarily for the next year. It's not like investing in capital. I mean, you're investing in an asset that doesn't work for you full time. So how is that?
It's a great point, because really what you're trying to do is Uber. It's any nod or any consumer, what they're trying to do is once you get a consumer or a driver into the platform, then there's the monetization on Uber Eats, on Freight, and ultimately on autonomous. So what you're really trying to do is put more of a fence around your backyard in terms of Uber versus a Lyft or other competitors. That really is a defensible position. You look 91 million active users in a month versus a Lyft. That continues to be the value of the Uber platform. And that's why investors are looking, can this be the Amazon of transportation? Can you monetize it? That's why right here, it's much more of a different distribution model than a Lyft, which we continue to view as the little brother to Uber.
Do you cover Amazon?
Don't cover Amazon, no.
Okay.
Yeah, I mean, you know,
What do you think of that comparison? Because that's been made.
Look, I think with Amazon, what was pretty clear relatively early on is that it was simply a drastically better consumer experience when it came to buying things online. It wasn't always necessarily the cheapest. It still isn't always necessarily the cheapest, but it's just a fundamentally better experience. I don't know that there is that opportunity to differentiate the product as much in ride sharing. So, you know, I maybe resist that analogy a bit when Uber tries to sell itself that way. Ultimately, what they want is that when people are looking to travel anywhere, you know, that they would presumably use a car for, maybe they're going to go to Uber first, and I think they've got a shot at that. But in terms of kind of that Amazon kind of franchise value and differentiation, I'm not sure that you really have that in ride sharing.
Okay. It's a longer debate, and we will have it not only for the next week before they go public, but for many years, I imagine, afterwards.
Some of Tesla's ancillary crap, I think, just costs money. And the sum of the parts, you subtract the sum of the parts from, right? I mean, how do you know you shouldn't subtract all these? They're going to put so much money into this stuff that you're saying is additive, and it's just going to end up, these could be loss leaders.
Yeah, and it's a great point. And I would say on Tesla, and some of the parts are a good example, like solar in some of the areas, have actually taken away from
what I mean. Why won't that happen with it?
Here, the reason is that they're able to actually monetize from a distribution platform. If you go to a typical Tesla customer, you can't monetize in solar.
I just wondered about that.
Yeah, no,
it's not always good to have a bunch be all over the place. You don't even know what
100%.